joining us right now, joining us today from Minneapolis, I should say. Jim, great to have you back here on the program. Let's start off with the point that Caroline was just raising there, the idea that we're getting some relatively decent economic data, or at least better than some people had expected, and presumably the vaccine rollout is starting to pick up a little bit of steam.
Yeah, I think it's becoming noticeable. You know, the thing is, Romaine, to me, if you get a shot in the arm of the elderly in this country, you know, you're going to dramatically at that point downshift both hospitalizations and cases and deaths, certainly. And I think we're already seeing some progress on that front. So I agree with that quote. Not only does it reduce the idea of a recession this year, I think it radically increases the growth rate outlook. When you combine the amount of stimulus that we're dumping on this thing, $900 billion just passed, another maybe $2 trillion coming imminently, tremendous pent-up demands bolstered by record-setting savings, and then a shot in the arm, I think we're going to have one of the greatest, fastest growth rate years of the post-war era, maybe real GDP in the 6 to 8% area for the full year.
That growth, Jim, enough to vindicate some of the so-called frothiness, as we'd like to call it, in the markets, the record highs we're near at in the benchmarks, some of the exuberance in individual names like, well, today, Eastman Kodak even.
Yeah, I hear you, Caroline. I think it will be. I think current street estimates for the S&P 500 earnings this year are around 165 to 170. I think if we get the kind of growth I'm looking at, we're going to come in at like 195 on the year. We're soundly beating earnings third quarter, fourth quarter. The first quarter numbers are coming up. I think we're beating fourth quarter numbers by 20% on average. So I think it's going to be a big beat. To the extent of sentiment, there's this idea we're in a bubble and everyone is way too giddy. I keep coming back to if it's too giddy now, how giddy is it going to be maybe in the fall time in this country when some significant portion of the herd is vaccinated, people are starting to roam freely again, can socialize, can go to restaurants and entertainment together, and industries closed or reopened and jobs lost or regained, and there's just a palatable sign of relief. If this is over exuberance today, what's it going to feel like then? So I think sentiment's going to be a lot giddier than it is today, and in the interim, that probably runs through the stock market as well.
How do bond yields impact sentiment? We were speaking with two strategists yesterday that said they could see 2% on the 10-year by the end of the year, but stocks don't freak out until you get to 3.5%, 4%. What do you make?
I concur with a lot of that. I think we're going to see 2% bond yields by the end of the year as well. I think the headline inflation rate, CPI, might briefly hit 4% sometime this year just on the basis of oil coming through. The core is not going to move up as much, but I think the headline might. And when I look back, what I find is yields below 3%, the stock market actually does real well. In fact, I just did a piece not that long ago that given the incredibly record low yields that we have, when yields go up, it's actually another stimulant for stocks. And I think we're seeing that already. The fact that we could get the Treasury yield back above 1 reduces the fears of negative yields. It encourages people that the economy is responding to all the stimulus. I think it's actually adding to confidence. And I think it's going to be a bloody year for bondholders, and that might as well ultimately drive people more towards stocks if they start getting hurt in bonds, not just underperforming, but if they start to hurt them, they may reallocate some of their assets back towards stocks as well. So higher rates this year could be a stimulant.
And Jim, I just want to get your thoughts here, too, on just kind of the general market structure, the equity market structure with all the retail frenzy and all the concerns here about what that might have implied. And, of course, now regulators starting to dig around and us try to sniff out what happened here. Any concerns here about what happened?
Yeah, Romaine, I'm still trying to understand it all. That's a new phenomenon.
Okay.
Yeah, that is a new phenomenon. I'm not quite sure what to make of that. The anger in it is what makes it really new. There's a lot of speculative frenzy based on greed, but this one seems like frenzy based on anger, and that's a new animal, I think. But I think there's some good things here. The fact that retail community at a young age is getting involved in the financial market, that's just a home run, and will pay dividends for everyone in this country in reliquefying the stock market down the road and allowing more and more of the population to be an owner and to have a share and to have a vested interest in Wall Street. I think that's all good. But I think that when I look at that situation, I don't care if it's individuals or it's high-skilled institutional investors. That was, to me, collusion in order to manipulate the market. And by almost any definition, that's why we have an SEC to stop that type of activity. So I think it's worthy of looking into this and find out who did what. And if there was obvious collusion of going on a website and saying, come join me, let's go manipulate this stock, something has to be done to that.